Welcome to today's webinar featuring Cathie Wood, hosted by CFA Society Chicago's Distinguished Speaker Series Advisory Group. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you would like to ask a question, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Dan Castholm, CFA, Managing Director and Regional Group Head of Fitch Ratings Latin America Corporate Finance Team and Chair of CFA Society Chicago's Board of Directors. Joining Dan for today's discussion is Catherine D. Wood, Founder, CIO, and CEO of ARK Invest. ARK aims to identify large-scale investment opportunities in the public markets resulting from technological innovations centered around genome sequencing, robotics, artificial intelligence, energy storage, and blockchain technology. She previously spent 12 years at AllianceBernstein as Chief Investment Officer of Global Thematic Strategies. I will now turn it over to our moderator, Dan Castholm.
Welcome, Cathie. So happy that you're able to join us for a little chat with the CFA Society of Chicago. As Chris mentioned, I'm the chairman of the board of the society, and well, thank you for joining us this afternoon.
Well, my pleasure. Thank you for having me. Very happy to be here.
Yeah, so as Chris mentioned, I thought we'd just have just a brief chat, and we'll go on a little bit, and then at the end we can take some questions, and we can go through them and get your thoughts on a few of these topics. I wanted to start first a little bit about you and your background, and how you got into this business.
Oh man, I got into the business when I was in college in the 70s. I started at Capital Group on the West Coast, introduced to capital by Art Laffer. You may know Laffer curve supply side economics. And I fell in love with the business. I said, wow, I get paid to learn how the world is going to work. I love this. They were studying Hong Kong 1997. I was a junior in college in 1977, and I said, wow, this is what I want to do. And then I was very blessed to have great experiences working with some of the finest companies, Janus and Associates. I was there and really cut my teeth on technology and innovation there under Sig Sigalis, who is still Chief Investment Officer and really an incredible mentor to me. And then from there moved on, did a hedge fund stint for a little while, and then on to AllianceBernstein, where I became head of Global Thematic Strategies. And then in 2014, I started ARK. And the reason I started and really left what I consider the traditional asset management world was I saw a shift, especially starting after the tech and telecom bust, and then the meltdown in 08-09, a shift toward risk aversion and benchmark sensitivity, and really an accelerated shift into passive strategies. And we were moving in the opposite direction on my team, and I just felt it was important to found a firm that would be focused exclusively on disruptive innovation, given how much disruptive innovation is about to take place. We're in the middle of it, and the coronavirus has accelerated it. But I felt that this was a void that was not being exploited in the public equity markets, and that too much capital had pushed into the private markets seeking innovation when the low-hanging fruit is in the public equity markets.
So you had a great idea. A lot of people have great ideas all the time, but you actually transform that into your own business. So I know we want to talk a little bit more about some of your investment ideas and things like that, but just to make the leap from employee to employer, what sort of it sounds pretty difficult. What prompted you? Were there any people that pushed you in that way? What were some of the challenges? I mean,
yeah, we were becoming an otter duck where we were. Because as there was a shift with more quantitative research into more benchmark sensitivity, we were moving away from the benchmarks. So philosophically, there was a reason to part ways. And then the other thing, and as important, I would say, is was the desire to open up our research architecture and start engaging with the communities we were researching, become a part of the innovation communities, whether it's genomics or artificial intelligence or autonomous and electric vehicles or blockchain technology. Actually start communicating with them and bringing them into our research ecosystem. And the other thing that I wanted to do, which was really not possible, except in a small way perhaps, it was to change the way the responsibilities of our analysts were organized, because I felt there were a lot of fall through the cracks opportunities that were being missed. And that's because technology is seeping into every sector. It is blurring the lines between and among sectors. And the innovation platforms around which we've centered our research cut across sectors. So, and in fact, a good example of that is autonomous taxi networks. They involve 3 of the 5 platforms: robotics, autonomous vehicles are robots, energy storage, they will be electric, much cheaper than gas powered out in the future, and artificial intelligence. They're going to be powered by artificial intelligence. So I felt that we could take advantage of some of the inefficiencies that have evolved in the traditional asset management world because of the way research departments are organized. Very siloed, very specialized, very short term. And our time horizon is a luxury. Our time horizon, our investment time horizon is 5 years. And the way we tried to position this in terms of helping people understand what we were doing was to say, we're the closest you'll find to a venture capital firm in the public equity market.
Yeah, that's pretty difficult, isn't it? How do you manage that with a 5-year? It's not like you have lockouts where investors can take their money at various times. And some of these things, I was looking at your big ideas 2020, very interesting 57-page research on your key themes. I enjoyed it very much. It seems, particularly in certain aspects, it seems there's a contrarian approach to some extent, and to the extent that you have big expectations relative to market expectations, is there, and if they don't hit within the next couple of years, maybe you don't perform as well. How do you guys manage that in terms of when do you have to punt on an investment?
Well, what we're doing right now, because there are so many opportunities to do it, is we are encouraging the companies we're investing in to invest aggressively today, to forego short-term earnings in order to capitalize on these exponential growth opportunities. And so what happens is you see these companies, and Tesla was a good one, Amazon in the old days was a good one. You see them pouring all of their earnings into the next big thing. And that upsets analysts and portfolio managers who have more of a short-term time horizon. So we effectively, when you say contrarian, we lie in wait for those opportunities just because we understand how traditional research is set up and what traditional time horizons are. So we lie in wait for those opportunities and to build positions. So that's why we might seem somewhat contrarian. But in terms of keeping ourselves honest, that's very easy. We have both top-down research and bottom-up research, and then a 6-metric scoring system. The top-down research is all about trying to figure out the learning curve associated with each of the 14 technologies involved on these 5 innovation platforms. Each one of them has a different cost trajectory to the downside because they're technologically enabled, so falling costs as the learning curves evolve. Once we've figured out what those cost declines are going to be, and just, I know this is a more sophisticated audience, so I'll just tell you what the starting point for analysis is. It's Wright's law. Wright's law is a relative of Moore's law. But it works better, even in semiconductors, than Moore's law. Wright's law is a function of units. Moore's law is a function of time, every 18 months to 2 years. Wright's law says for every cumulative doubling in units produced, costs decline at a consistent percentage rate. And so to give you an example, battery technology today, for every cumulative doubling in the number of batteries or electric vehicles produced, battery costs decline at an 18% rate for every cumulative doubling. So you know when we say cumulative doubling that we're dealing with exponential growth, early growth and exponential growth. So that's our starting point. Now, the next important variable we have to figure out is, are we ready for prime time? Which is probably the genesis of your question. We might be right on the technology, but are we ready for prime time? The learnings associated with the tech and telecom bust is, these technologies all had great potential, but there was too much capital chasing too few opportunities too soon, and it ended in tears. And so that's what people fear in our strategy. But what I like to point out is the seeds of our strategies were planted in the tech and telecom bubble. And they've taken 15 to 20 years to gestate. And now we're ready for prime time. How do we know that? Just a quick example there. DNA sequencing. In the early 2000s, it took $2.7 billion and took 13 years of computing power to sequence the first whole human genome. We were nowhere ready for prime time. Even though biotech took off, we weren't ready for the real biotech or genomic revolution. Today, we're down below $1,000. Some companies in the private markets can sequence a whole human genome for $500, and we're going down to $100, we believe, within the next 5 years. We're ready for prime time. We are now going to learn how our bodies are mutating, our genomes are mutating, so we can figure out where the diseases are in stage 1 for cancer. So we're ready for prime time. So we're able, with the price elasticity of demand, to say, okay, given the cost declines possible out there, units should be exploding. And actually, genomics is a good example. Illumina hasn't been cutting costs as quickly as we think it should. And so its top line growth has slowed down. So we will be looking at that and encouraging a company like Illumina to get aggressive and move down that learning curve so that they can help remain at the leading edge. China's coming after them and help transform the way healthcare evolves.
Okay. So a lot of interesting ideas out there. So in terms of, let's talk about a few of these sectors in terms of, relative to the market, disruptive innovation. How did these, and we talked a little bit about you spoke a little bit about the dot-com bubble and sort of being the, sort of the leading creation of a lot of these ideas. I think my question is how, from a market perspective, with this strategy and these types of investments, what's their relative performance, either in an up market or down market, specifically, with potential downside risk here, given the pandemic, you know, what's anticipated in our the U.S. GDP. I've seen quite a few different numbers, but negative GDP of we'll say about 6%, global growth contracting 4.6. With that sort of global scenario, how does your portfolio react given these technology disruptive innovation type investments?
Sure. Typically, during a downturn or a risk-off period, and for goodness sake, since we founded the firm, we've had so many risk-on, risk-off periods. We know this to be true now. Typically, during the early stages, this strategy will underperform. Why? Because risk-off for most portfolio managers and analysts is, okay, let me get closer to my benchmark. We're in an uncertain season here, and I want to lower my risk relative to my benchmark. And most of our stocks are either not in benchmarks or they are very small parts of benchmarks. Our tech is the opposite. As we go through that underperformance, we are concentrating our portfolios towards our highest conviction names. So there is that period of underperformance. And during the coronavirus, it might have been 8 days that we underperformed. But as I always tell my team, and as we've seen increasingly in these risk-off periods, innovation always gains accelerated market share, meaning market share at an accelerated rate during risk-off periods when consumers and businesses are scared and they're willing to change the way they do things. So this is a perfect proof of concept of that, the coronavirus. Whether we're talking about online education, so 2U, or virtual home tours, Zillows, or digital work life. So not just the obvious plays. We did own Zoom, but sold it as it was going up and everything else was capitulating. And Slack, those are obvious. But what we're not so obvious plays are the back-end infrastructure plays, absolutely necessary to help these consumer-facing or business-facing services scale. So it's been an incredible period to invest in what we do, because our companies are the solutions to the problems that have been created. And maybe the best case in point there is genomics. If we were not able to sequence COVID-19 in 2 days, which China did, in 2 days it had sequenced that genome, compared to the 5 to 6 months it took to sequence the SARS genome in 2003. If we had not done it in 2 days, we wouldn't have had the tests. And part of the reasons we had the test is synthetic biology, Twist Biosciences, was able to read the genome, write the genome, send the instructions to the testing companies within a 2-week period. And then, of course, we have the vaccine companies, the flood of money into vaccines now. We own two of the important pure play testing companies. So it's been an incredible period for the genomic revolution, and it has been our best performing fund this year, because people understand, wow, look at how the world has changed. My guess is we would have been closed down a lot longer had it not been for the tests that were derived from the sequencing.
Okay, so of your convictions, your investments that you really can have a lot of conviction. What are some of those, sort of synthesizing, honing down into a few of your themes and.
So, well, we're very well known for Tesla, so I won't spend too much time on it, but that it's a perfect example of the arbitrage we're playing between short-term analysis and longer-term analysis, short-term forecasts and longer-term. So we're well known for our base case right now for Tesla is, and we've adjusted now for COVID-19 interruption, is $6,800. The stock today, I think, is at $844. That is, yeah.
Close.
That's a 5-year time horizon. And you can go on to GitHub and see all of our assumptions and play around with them, because we felt that we needed to put that model out on GitHub. First of all, we wanted it battle tested, and the best way to find out when you've made a mistake in your model is to put it up somewhere when there's a lot of controversy and people will attack it. And that's
well, yeah. And I think in your big ideas you had, that's probably where I was referring to the contrarian, because I think if you look, I think in the big ideas you show that I think it was the EIA or something like that had X amount of growth for EVs, and yours is substantially higher, which would drive that type of evaluation.
Yes.
Which leads me to that's a 5-year, but we're in the face of a huge decline in auto sales this year. I think it's all over the map, but potentially 30% in vehicle sales.
Yeah.
Globally, and maybe still in 2021 still below 19 levels. So does that provide some sort of, at some point it becomes survivability, liquidity, less than, growth?
Yeah, so in about a year ago, May of 2019, the fear was Tesla was going to run out of cash. It was scaling the Model 3 production, and the analysis, the scrutiny of it back then was extreme. We got down to a low of $178 at the last year, and as I just mentioned, we're at $844 today. And back then I was saying, that's a curious worry, because the markets are open. This is not 2008, 2009, when I do remember saying, when it came to some of the financial stocks back then, and there was a debate, should we let the markets work and just, that's it. And my attitude was, the markets aren't working. They're not working. Markets are working very well right now. And, those of us who are strong holders would have supported a deal, and did support a deal when it did take place. So I can tell it's been a whack-a-mole stock. First, all along, the ability to scale, well, first of all, the concept of electric vehicles was in question from the very beginning because of range anxiety. Then we solved range anxiety. Then the ability to scale manufacturing was a worry. Then the demand was a worry. Then accounting was a worry. Then cash was a worry. I know, and I've been through, I've been around the block, as you might surmise, a few times. I know when the only thing that analysts and portfolio managers want to talk about are the negatives, that they're being discounted fully into the stock at some point. So we'll always average down into a market like that. And so we averaged down and kept the position at 10%. We can buy up to 10% in the portfolio. And of course, it's been one of our top performers this year. So the arbitrage between the long term and the short term, Tesla is quintessential that. Now, if you fast forward just a year, Tesla's balance sheet looks like a fortress compared to the traditional auto manufacturers. They're the ones who have the problem. If anything, Tesla's gained on the traditional auto manufacturers in terms of electric vehicles and autonomous. They've gained in terms of their battery technology, their artificial intelligence chip technology, the number of miles they've collected, which is critical to autonomous, and their over-the-air software updates. Each one of those are barriers to entry, barriers to entry is one of the 6 metrics that we score. And on each one of them, they've pulled ahead in the last year, while traditional auto manufacturers have actually pulled back. They have to. Their balance sheets will not allow them to invest as aggressively as they once did in electric and autonomous. They're not going to tell you that all the time. They're going to say something different, but we do know Cruise Automation, for example, owned by GM, just laid off 8% of its labor force. And they hired them in a rush last year because this was such an important initiative. Now because of balance sheet concerns, they don't have any choice. So Tesla's being a pure play and its R&D being focused solely on electric and autonomous has given it competitive advantages that no one wished to see during those dark days.
Mm-hmm.
But we saw them growing, and you know, because I'm on Twitter, probably the most trolled portfolio manager in the world, especially when it comes to Tesla. I remember I didn't know I was.
You do come up on whenever you Google Cathie Wood. Oh, Tesla, right there. So
Yeah, right there.
it's
Well,
obviously a conviction of yours.
yes, yes, but it was, and sure, it's a conviction. We have such high conviction in our other names as well, but that
What would
one,
be another? Give us another one that you really, really like and that you have a sizable chunk of your portfolio in. I think
yes,
that's a pretty
so
good position.
sure. Square is another one. Square in the, we really think that digital wallets are going to disintermediate and disrupt traditional banks. Cash App is owned by Square. Venmo is owned by PayPal. We think Cash App is the more agile of those two, but they'll both win. And what we're seeing, and especially with COVID, again, this is another example where we're seeing a crisis elevating our companies. What are the worst virus spreaders in the world? It's not cash, it's credit cards and debit cards. So this idea of contactless payment systems has taken off. And if you compare the network effect or the virality of these digital wallets, they are happening twice as fast as Facebook and Google and other social media did in the day, more than a decade ago. And why is that? Well, in the day, my children, who were teenagers at the time, did not want me to follow them on Facebook. However, when it comes to Cash App, yes, there you go. But when it comes to payments, right? Payment ecosystems, heck yeah, mom and dad. So it's happening twice as fast.
Well, my kids don't want me to know what they're buying.
That's true. There's some of that.
On my debit account.
But they don't mind you sending them some cash every once in a while, right?
No, they like that part.
They like that, so no problem. So we think banks are in harm's way. So what are the sectors we think are in harm's way? Traditional financial services, because these digital wallets are not just about the cash ecosystem that you and I are talking about here. But they are about enabling merchants with working capital loans, with capital spending loans, payroll systems. So they're insinuating themselves into our digital economy in a way that really would suggest that banks with old DNA have already lost. They're not going to win in this game. Zelle might be good for rent payments, but they're not. Zelle is not good for multiple payments per day. So Square, if in energy, we think remains in harm's way. The reason we're seeing a price increase now is because there's been a collapse in capital spending and a production cutback by OPEC and Russia. But we think electric vehicles and electric vehicle miles in particular, when autonomous takes off, which we think is within 2 years, is going to be a death knell to energy. So we believe we're going to continue to see lower highs in terms of the energy price and lower lows. It's hard to get below zero, which the futures market did. And we don't think that we will get there in the cash market. But energy is in harm's way as electric vehicles and autonomous vehicles take off. And the best play in that space is Tesla, bar none now. We're sure of this because of the 4 competitive advantages.
Okay. Maybe we can switch real quickly to the investment management industry in more general terms. It's something that's been debated quite a bit. You're obviously, you started your own firm. You're very, have grown assets under management since you've been in business. a lot of the managers, there's been this big switch. You know, I think the disruptive technologies or innovation has really impacted the investment management area. We've seen a big switch from active managers to passive management, a lot of fee compression we've seen. So what are your thoughts? How does the investment management industry survive, and how does it come out of this thing from an active perspective? But also, you know, can you play in it in any way, and have you in that disruption?
Yeah, no. When I first conceived of our research ecosystem in August of 2012, it just hit me. Okay, you're a student of disruptive innovation. Your industry's getting disrupted. And one of the first things we saw was, you know, ETFs just taking massive share from mutual funds. And so we began to think about it, and I thought, well, why don't I disrupt? Why don't I try and disrupt? I mean, it was maybe a big thought, certainly the asset management industry. And so we did a couple of things. The first one seemed like a mistake at first. We started with active equity ETFs, fully transparent. And we got up to about 40 million and then just stalled. We had a social networking, marketing, and media ecosystem, but we stalled because distribution.
Mm-hmm.
And we struck a partnership with Resolute, which owns American Beacon, and with Nikko Asset Management for Asia Pac. And but I don't think, if we didn't get our first institutional account, which was separately managed, and a pension fund for which I had managed money at AllianceBernstein, I don't think those distributors would have taken the minority interest in us and really lifted us off the way we did take off. That said, I do think that our differentiated approach, our communication, our willingness and desire to educate everyone about how the world is going to change, our very disciplined research, which you're not going to find any research like ours out there. I truly don't believe that. Maybe I'm hearing some people use Wright's Law now, and it's quite flattering. I love to hear it. But you know, to center our research on Wright's Law and be as disciplined around that research, both top down and bottom up research as well. We just don't care if a company misses gross margins by 30 basis points this quarter, especially if there's a good reason behind it having to do with how they're going to scale in some kind of exponential way going forward. So I really think that our willingness to communicate, try and help people understand how the world's going to change, and have them understand how the biggest risk today is actually to be passive and to be benchmark sensitive. Because the disruptions that we see sweeping through the global economy are going to disrupt and disintermediate the stocks that have attained high positions within the major indexes. They are where they are because of what has happened historically, right?
So basically, to read between the lines here, correct me if I'm wrong, so for there to be a shift back and to be passive is you have to have better returns.
Right.
And you have to beat the market, and you have to have alpha.
Yes.
Otherwise, you know, there's going to
Absolutely. And you have to believe enough in what you're doing. For example, our 5-year time horizon. If we have a quarter of underperformance, well, the first big test for us as a young company, fourth quarter of 2016, the election happens and the stock market takes off, value goes crazy to the upside, and we're negative. We're negative. And I have to answer to that first quarter, at the beginning of the new year. And I said, what has happened is fantastic for us, because if the value stocks, and I feel this way about this time as well in the markets, if value had not taken off, then what we were looking at was a narrowing bull market and a weakening bull market. What has just happened is the bull market has gotten stronger. It's broader based. That's what's happening right now as well. And I feel the same way. What's different between now and then is we are outperforming even on strong value days. Now, that's not always going to be the case. We're going to have periods of bad performance, and we can take them because of our 5-year time horizon. We have to get people.
And your investors understand that. So when you have negative returns or below market returns, your assets don't disappear.
Actually, in terms of just, let's take the coronavirus, we might have had, as I said, we might have had 8 days of redemptions, and we were underperforming. Then we started outperforming, and now we've had very strong inflows, which started.
So it really comes down to performance. It's
performance, and I think, you know, the tagline we've been using is innovation is key to growth, and innovation gains traction at an accelerated rate during times of crisis. We've been beating the drum for so long, and this other drum, which is watch out those of you who are wedded to traditional benchmarks, they are being populated increasingly by value traps. They're cheap for a reason. They're going to be disrupted. They're going to be disintermediated. And so even in this value market, and I do a video every Friday, or we started doing one with the first week in the crisis, just to hold our investors' hands and to actually, my background's economics from the early days, and we had a strong point of view. We were going into a V-shaped recovery, so I wanted to keep beating that drum as well. And I think beating all of those drums has helped us. Because more and more people understand there's nothing like a crisis to crystallize one's thinking.
So are we going to be a V, or are we going to be a swoosh recovery?
A
W?
Let's
hope not a W.
We've been using V. The relapse in terms of the virus would be a bad thing. We've been using V. We think the businesses are so far behind consumers. They have been trailing consumers, dragging their feet in terms of building inventories and capital spending, while consumers have built their saving rate now up to 33%. So I think we're going to see businesses scrambling to keep up with consumers, and I think that's the message from last week's employment report.
Okay, I'm going to ask a couple more, and then I think we have quite a few questions coming in. So thank you for everybody that is throwing in questions. I'm going to get to them in 1 second. So obviously you've had some winners, but everybody has a loser. In your career, your biggest loser, and what did you learn from it?
Okay, so I started in the industry 43 years ago. So clearly I've made a lot of mistakes, and, you know, I've been bruised enough to, you know, have this muscle memory. So that's good. But among them, I was the analyst in charge of Mexico when I was at Jennison. And in 1994, we had gotten very close to the companies, and those company leaders are very close to the, you know, leaders of the country. And so we thought we understood that there would be no peso devaluation. And guess what? There was a peso devaluation right at Christmas time. Just like, I had 3 little children at the time, and I had to have a happy face around Christmas, but boy, inside I was really hurting. So what that means is, you know, thou dost protest too much. If a country is saying, no, but the actual supply-demand variables are weighing on the side of devaluation or whatever is not expected, assume the worst when it comes like that.
I remember the tequila crisis quite well. I was there.
Yes. And so I don't let what leaders of companies and countries say influence me anymore. And I look at just the fundamentals. And And then in terms of stocks, I mean, I think the one that I was most embarrassed about, I think, was XM satellite radio. And it wasn't a killer to our performance, but it was pretty nasty. But the reason I was somewhat embarrassed was I hadn't pressed our team enough on, how this technology would scale. This is satellite radio. I think we had visions of streaming radio. Well, satellite's not the internet, and it wasn't going to happen. And I didn't press enough as the stock was misbehaving, saying, okay, could we be wrong on the technology here and the take up? And we were. So that one I really didn't like making, because the heart and soul of what we do is trying to figure out and understand how a technology is going to scale. So that was pretty tough.
I am, we've, gosh, I'm mindful of time. I don't want to take too much of your time, but we do have quite a few questions. Okay. And I am going to just start going through some of these, and I'm on my other screen, so I'm relative. And I use these things for two things: reading and fighting, and you can't hit a guy with glasses. So, let's see. Okay, this one's an interesting. There's quite a few. I think we have about 22 questions here. It's a lot. So some of them, would traditional banks start their own cashless transaction offshoots?
Well, Zelle is an example of that. And yet we don't think that this is going to scale. It's a DNA issue. It's going to scale the way that I'm describing Cash App and Venmo and other digital wallets like WeChat Pay, Alipay, scaling. And one of the reasons for this is banks have gotten used to a system. They experienced tremendous loyalty for years and years. I think at one point, the average loyalty for a checking account user was something, or a savings account, I forget which one, was 16 years. So they were willing to pay up to acquire customers, as we all know from the deluge of credit card applications we get. So if you look at what it costs the traditional financial institution to bring on a customer, it's about, depends on what the service is, anywhere from $350 to $1,500. For Cash App and Venmo, it's about $20. And it's because of the virality of the network effect, which banks don't have. That's not how they've built their business. So it doesn't surprise us that both Cash App and Venmo is the #1 in terms of number of digital users in the United States, #1 financial services company, and Cash App is #4. By the end of this year, we think Cash App could be #2, and Venmo that much further ahead of JP Morgan. And it's because of the difference between cost of customer acquisition and, again, the network effect that these companies are set up for and have created and are really creative in their marketing strategies, harnessing social media, compared to traditional banks. And in fact, what we think is going to happen to traditional banks is during the next, it's either 10 or 15 years, we expect their credit card revenue to be cut in half. And that revenue will go to the likes of Cash App, Venmo, and elsewhere in the world, other digital wallets. That's a very profitable category, source of revenue for them. And we do think that they're going to become more and more commoditized over time.
Okay. This one's about Tesla. How do you account for the disposal of lithium batteries used in electric cars? So it's more EVs, and is there sufficient lithium for new batteries, and can we reuse old lithium batteries?
Okay, great question. We have done it's up on our website, an analysis of a 10-year-old Tesla Model S versus a BMW Series 7. And if you do the 10-year analysis, the fact that utilities are going to be able to take those batteries that come out of cars and really have lower performance than the average customer will require, utilities will buy up those batteries because it will prevent them from having to build peaker plants. Peaker plants are used only 5–6% of the year for the extremely hot or extremely cold days. These batteries can help them top off their capacity in their existing facilities. And for that reason, the residual value of a Tesla Model S battery in 10 years, we believe is going to be higher than the entire car, BMW Series 7 car, not just the engine. So yes, that's there is JB.
So you're saying that given the growth that there's limited supply in lithium?
No, the lithium question has to do with lithium is widely available. The problem with it is it takes a while to build the mines. If you look at what's happened to the lithium price since Tesla and other electric vehicle manufacturers have committed to electric, the price has been cut in half, lithium price. And that's because there are a number of mines opening up. It takes 3 years. And a lot of people thought, oh my goodness, we'll have a shortage. Well, no, we won't, because all of the auto suppliers and Tesla have gone out and secured, basically given essential orders. You know, we will buy, or we will agree to this contract over any number of years. So lithium, we don't worry about. Cobalt, we do worry about. And JB Straubel, who was the chief technology officer of Tesla, left to start a recycling company for batteries, and is helping to solve that problem. So we are going to have a major recycling effort for those batteries not taken into utilities to top off and avoid building peaker plants. Okay.
And a lot of that is for solar. So at night, you know, you may not get sunshine. So
there's a whole ecosystem and then just on cobalt, a lot of which comes out of the Congo. Tesla is taking its cobalt content down. Well, they're aiming to eliminate it, but I think they're going to have battery day next month or this month, one of these couple of months. And I think we're going to learn how much cobalt they've taken out of the battery compared to other battery manufacturers. So, you know, Tesla's original goal was to save us from ourselves environmentally. So everything that it does is environmentally sound.
Okay. I have a couple questions that are sort of a little bit common. Can you speak more to your engagement with the investment community and with portfolio companies specifically? Are you increasing engagement with retail investors directly, who often has a certain fervor of the company, of the shares they hold? I think the first part, I saw another one, just, you know, how do you engage with management and the frequency and the type of engagement?
Yeah, much less frequently by design than traditional analysts do. And the reason is our 5-year time horizon. The best encounters with management are when a management watching our research go out there about the long term in their space, when their business development team comes to us and wants to have a call. And that happened with Tesla. It's happened with Square. It's happened with a lot of our holdings. And so we're engaging with them in a completely different way. It's all about the long term, which is what we want. And we don't want material non-public information at all. But we are already taking a point of view on where their industry is going. And sometimes it aligns with what they're thinking, sometimes it doesn't. So they really want to pick our brains. As far as engagement with our clients, yes, our clients love our outreach, for example. every Friday, we put out a list of stocks that have gone up or down 15% on any one day during the week. And then we'll just on Friday write it up and say, this is why it went down. It's usually a short-term reason. And here's the long-term reason we hold the stock. So our clients, both institutional and retail, love that. They also love the fact that we display our holdings at the end of every day, and we put out our trades each day once we've completed them. So they can see what we're doing at the margin. And it gives them a real feeling of, engaging with us, engaging with the portfolio. They have a sense of where we're going. We're absolutely willing to not only discuss the losers, which we do when we have 15% decliners, but also the winners. So, there are two sides here. I think our market has gotten used to volatility just being negative, but volatility is a very good thing on the upside. And we want to make sure we continue to reinforce that point. We also do regular webinars. Tomorrow we have our market update. We do that once a month. Second Tuesday of the month at 1:30. We do a quarterly, once a quarter, to bring all our analysts in to talk about winners, losers, and performance generally. Even though we're long-term in our orientation, we'll answer for any quarter that our clients really want to understand. And we are prolific on Twitter. And all of our analysts have their own handle. So you can actually engage with the analysts, ask questions, retweet, like. So, we're very engaged and engaging. And the I think anyone who follows us on Twitter, if they want to learn more about an innovation platform, follow the analysts on that platform who work at ARK, and you'll see who they follow. And then your own ecosystem will be so much richer. I believe we're the first sharing economy company in the asset management space when it comes to research. And in the sharing economy world, when it comes to research, if you don't give, you don't get. So most analysts can look at Twitter and see what people are saying. But because we're willing to engage out there, we're getting innovators talking to us and telling us when they think we're wrong, which is the most important thing that can happen when a company is trying to understand exponential growth curves. Because if we make an assumption and it's wrong, we can make an exponential mistake, and we don't want that to happen.
Okay. That's a very good answer. Let's see here. Oh, I should have this ready. Quick question, very quick. Do you guys ever short stocks?
No.
Long only?
Long only.
All right. How did you get interested in biotech? And how do you research and analyze it? How do you value these things? Most of the time, I met a guy just the other day, worked for a biotech company, and said, oh, we have a $45 billion valuation, or $4.5 billion valuation. I said, do you make any money? He goes, we're biotech. How do you analyze it?
Well, again, very methodically. I think one of our competitive advantages in any space is domain expertise. So Simon Barnett, we got him fresh from Johns Hopkins, biochemistry, and we have Ali Ehrman. She came from McGill and Sloan Kettering and IBM Watson and MIT artificial intelligence expertise. And so you're not going to find other analysts like that out there. So they understand how the world is changing. First of all, they have one foot in it. And in the case of the genomic revolution, once we understood that DNA sequencing had hit prime time, meaning below $1,000, which happened just in the last few years, we began to look at everything in the space, including CRISPR gene editing. And here's how I can tell you with a straight face, not only that we're a deep value manager, because I believe we are, if you give us 5 years, but that we are not in a bubble, not anywhere close. If I had told you in the tech and telecom bubble that there were 3 companies with the foundational patents that were actually going to cure disease, not just treat symptoms, but actually cure disease, reverse the programming errors, or edit out the programming errors in your genome once they went haywire, and prevent cancer, and prevent sickle cell, or cure sickle cell, cure pediatric blindness. If I had given you that story in the tech and telecom bubble, those 3 companies would have scaled collectively, I believe, to somewhere in the $200 to $300 billion market cap range. The 3 companies today, Intellia, CRISPR Therapeutics, and Editas, the 3 of them collectively cannot even get to $10 billion. They're closer to $5 billion. Now, Apple is well over $1 trillion right now, and Apple has changed our lives, but Apple has not cured disease. And I think these are hugely undervalued stocks out there, because we are getting the earliest clues that they do cure human beings of beta thalassemia, sickle cell disease. We're soon going to see results on pediatric blindness. And there are a whole bunch of milestones this year. And I think this is the genomic age, the genomic revolution is probably the most underpriced and underappreciated theme we're investing in.
In terms of that technology, or at least in terms of the vaccines that are being developed for the COVID, I mean, are they using genome sequencing in terms of, I understand the technology they're talking about is what? Is a messenger RNA?
Yeah,
they're inserting that into a cell. So that would be a new technology.
Yes, first time ever done. First time ever done. And Moderna and Arcturus are the 2 companies going after it. I mean, in a major way. Right? We own one of them and not the other, but they're both really fine companies. We would not have been able to get there without first sequencing the COVID-19 coronavirus. So that was Illumina. Illumina read the sequence. Twist Biosciences wrote the sequence, handed it off to the testing companies. So Abbott and Cepheid, which is owned by Danaher, got that instruction set in 2 weeks from the sequencing of the, and so they were able to turn around tests, right? Couldn't have been done before, could not have been done. And yes, Moderna and Arcturus are mRNA, and Inovio is DNA vaccines. First time ever. Arcturus, if you want to understand the differentiation between Moderna and Arcturus, Arcturus is self-replicating mRNA. And what that means is it will only need 1 dose. It will not need a booster. And it will be able to scale. The dosing size is very, very small because it self-replicates in vivo.
Okay.
So it'll be able to scale. This is where the real bottleneck is going to be for a lot of companies. It'll be able to scale much, much more quickly than I think anyone now understands.
It's an amazing time, and it's amazing what's happening, and the efforts by all these companies to come up with a cure, so we can actually go back to work.
Yes.
Even though this is work, but it's fun.
Yeah, we haven't skipped a beat.
Zoom, everybody's learning Zoom right now.
Well, not only that, I think we've all become a little more productive, believe it or not.
Absolutely, absolutely. Yeah. Everyone says they use their travel time plus home time for doing things and being more productive. Let's see, we have we're almost at an hour. We still have some more. Let's see, I'll take. I don't know about that one. Do you avoid the obvious industry leader?
Well, you'll notice we don't own the FANGs in our flagship portfolio. Our flagship combines all of the 5 platforms and 14 technologies. And the reason for that is, first of all, we know these are large cap stocks. They're in indexes. They're in our other portfolios because they're much more specific to next generation internet or the autonomous technology and robotics fund. But in the flagship, we don't own the FANGs. They've scaled, they've had we're owning the FANGs of the future. The ones that will be big parts of future indexes. And I would like to plug something that's happened recently here that might be of interest to the listeners and viewers. MSCI just launched a number of innovation indexes, and we're very happy about it and proud of our contribution to it. We're at arm's length. They are developing these indexes. I can't even talk to them as a portfolio manager, but our research team worked with their research team to identify keywords that their artificial intelligence tools can scour the world for and create very well diversified portfolios in the space. So their portfolios will be 400 to 500 versus ours, much more concentrated in the 35 to 50 range. But I think the wonderful fallout from this is that one of the reasons I founded the firm was because I felt that the US needed to keep its lead in innovation, and that there was a capital shortage for innovation in the public equity markets. And I think this is really going to help us pull ahead. I think that this will institutionalize this strategic allocation to innovation in a way that we certainly could not have done alone. So really thrilled about that.
That's awesome. Let's see. Are your monthly updates open to anyone, the public, or just your investors? Okay.
Yeah, anyone. And so are our brainstorming sessions on Friday from 10:30 to 12:30 every Friday.
Okay. Do you guys look at ESG in your investment analysis?
Yes. In our 6 metric scoring system, the first one is management, so people and culture. And that's that's where governance resides. And then the 6th one is thesis risk. And increasingly these days, if there are bad actors out there from an ESG point of view, they are typically going to become bad investments. They're going to be banned from portfolios. One thing that we're doing a little, so that's certainly a part of our scoring system as is. We are also very focused on the Sustainable Development Goals at the UN. And we are mapping out our 14 technologies and 5 platforms alongside them so that our investors and the UN and anyone who would like to see them understand how well aligned innovation is with these SDGs. And that work should come out within the next 3 to 4 months.
Okay. Let's see here. We have a few. We talked about biotech companies, and you've mentioned the companies you like in biotech, so I think we did that one. Oh, someone asked, this was related to EV. I don't know if we asked this one or not. If I did, forgive me. How do you do a DCF on a exponentially growing company like like Tesla, for example?
Yeah, so our starting point, okay, 5-year forecast, what will electric vehicles sales be globally? Not just for Tesla, but for the world. And we come up with a number. Right now it's 37 million, whereas the traditional agencies out there forecasting this space have maybe 6 million, something like that.
And that's how you get to your 4,000 price 5-year price target.
Yeah, well, we were assuming for a long time that Tesla would lose share. Its share last year was 17% globally, including China, which is going to be the largest market. And our assumption was with all these other electric vehicles coming out, they would lose share. They are not losing share, they're gaining share. And in fact, others are stumbling. And so our confidence in our bull price target, which I won't even mention here, has increased during this coronavirus. If you saw in China this morning, Tesla was the largest selling electric vehicle in China. Now that is really saying something, because there are 100 other vehicle manufacturers going after electric vehicles, and they are merciless in terms of getting the cost down and, you know, out competing. And yet Tesla is like Apple. It's a status symbol.
Well, another one on Elon Musk, just with SpaceX. Does that benefit his other investments? Which company will benefit the most in the space sector?
Yes, it's been really
more specifically, I went on to say, are there some supply companies to SpaceX that she can name that you would be interested in?
Right. So we actually have a space exploration fund in Japan. It's very small. You know, surprisingly, one of the most common investments is 3D printing, because spare parts are going to have to be 3D printed in space. They're not going to come down to Earth to fly back and forth if something serious goes wrong. So you'd be surprised at the 3D printing companies that are involved, and Tesla's using them all. So that's a bit of a sleeper one. And in fact, it's used on satellites. We have a lot of satellite companies in the portfolio. Air Environment's a drone company. Tesla's been, it's been proving out this thesis of reusable rockets, and they're designed by SpaceX in conjunction with NASA now. And I think these two organizations are having, just an incredible time together. They are so pumped up, one pumping the other up, whereas in the past, there always used to be this clash between public and private. We're seeing something really beautiful happen. And the admiration that NASA has for SpaceX and the admiration that SpaceX has for NASA, I think is going to move us much further ahead in the space age than our competition. And that includes China. And I think the real wake-up call was China launching and landing on the dark side of the moon. That really pumped everyone up in the United States. So I love the competitive battle that we are having with China. It's going to be great for the US. There's nothing that gets us to, to challenge our limits than competition. So, very excited about space.
That's awesome. Well, Cathie, I just want to thank you very much for joining us. We did go over the hour. I'm sorry for all the people that did send in questions that we weren't able to respond to you. Hopefully we touched on the topics that you wanted to hear. But Cathie, a big thank you for joining us and taking time out of your day to speak with us about your firm, your views of the market and disruptive innovation, and where the world is going next. So thanks again.
My pleasure. And if there are a lot of unanswered questions, if they would like, they can shoot them over to ark-invest.com, and we will get them to the right analyst, or to me, or Ren Legge, our client portfolio manager.
That's fantastic. Well, thank you again.